All right, welcome back. This is class number 2. We're going to get into technical analysis. So like I said before, technical analysis to me is the best form of, of, of trading and a way to you to minimize your risk and maximize your reward. Without seeing the actual price movement on the chart, it's going to be very difficult for you to understand when is the right time for you to buy and sell your stock. A lot of people choose to do fundamental analysis, which basically is taking the news and watching the news and gathering all the information that you can on the internet and other sources to figure out if it's time for you to make an investment or trade. That can be very limiting, but it could be profitable if you become very good at it. But what I do is I use technical analysis, so where I can see the actual price movement, use the technical advantages that I have when I use my indicators and I use my other setups, read the candlesticks, read the chart patterns, put all that stuff together, and then add fundamental analysis to it to give me a little bit of confluence to let me know that I'm looking at the right thing and that the stock is going in the direction that I think it's going to go. So we're going to go into a few things. Right now, we're starting out with candlesticks. Candlesticks is very, very important because when we pull up the chart and do our technical analysis, we're going to be using candlestick charts. And when you understand the candlesticks and what they actually are saying, it will give you all the information you need to gauge what direction the stock is going. And also there's patterns inside the candlesticks that you can read and recognize that will give you a trigger to let you know which direction the stock might go in the future if there's a reversal in the trend. All right, so let's get into it. So candlesticks charts originated in Japan over 100 years before the West developed the bar and point figure charts. In the 1700s, a Japanese man named Homma discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Candlesticks show that emotion by visually representing the size and price moves with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of price. So one book that I suggest you guys read off the bat is the Candlestick Trading Bible. All right. This is a book that's going to break down candlesticks and allow you to learn how to read them and give you some strategies to where you can be very, very profitable when it's time to gauge trends and trend reversals, entries, exits, all that. Definitely get the Candlestick Trading Bible. You can find it on Amazon. You can find it in most bookstores. This is definitely something that every trader should have in their arsenal, especially if you're dealing with technical analysis. All right. Key takeaways. Candlestick charts are used by traders to determine possible price movement based on past patterns. Candlesticks are useful when trading as they show 4 price points: the open, close, high, and low throughout the period of time the trader specifies. Many algorithms are based on the same price information shown in candlestick charts. Trading is often dictated by emotion, which can be read in candlestick charts. All right, so candlestick components is very, very important. In order for you to understand how to read the candlesticks, you have to know exactly what each point on the candlestick represents. All right, so just like a bar chart, a daily candlestick shows the market's open, high, low, and close price for the day. The candlestick has a wide part, which is called the real body. The real body represents the price range between the open and close of that day's trading. When the real body is filled in or black, it means the close was lower than the open. If the real body is empty, it means the close was higher than the open. Traders can alter these colors in their trading platform. For example, a down candle is often shaded red instead of black, and up candles are often shaded green instead of white. So in this particular example, you're going to see the black candle and the white candle. You need to understand the term bullish and bearish. All right. So in this case, the bearish candle is painted black, colored black. Bearish means downward price movement. It means the price is going down. All right. So when you see the bearish candle, you can see that the open price is here at the top of the body and the close price is here at the bottom of the body. All right. That means that when the stock market opened at 9:30 a.m., Monday through Friday, the stock price started here. And then when it closed at 4 p.m. Eastern time, Monday through Friday, it closed down on the bottom where it signals that down here. All right. These two lines right here is what we're going to get into next. So again, now you see the white candle, all right? And on my chart, the bullish candle is green and the bearish candle is red. On this example, the bearish candle is black and the bullish candle is white. So on this white candle, which is the bullish candle, you see the open price is down here and the close price is up here. That means that when the stock market opened at 9:30 a.m., this daily candle opened at the bottom, which is here. And then at 4 o'clock p.m. Eastern time, when the market closed, it closed up here, all right? So candlestick versus bar chart. So just above and below the real body are shadows or wicks. The shadows show the high and low price of that day's trading. If the upper shadow on the down candle is short, it indicates that the open that day was near the high of the day. A short upper shadow on an up day dictates that the close was near the high. The relationship between the day's open, high, low, and close determines the look of the daily candlestick. Real bodies can be long or short, black or white. Shadows could be long or short. All right, so just so we could go back and use this as an example. Again, this is the bearish candle. This is the bullish candle, right? The top part, that's the wick or the shadow, all right? The bottom part, that's the wick or the shadow. So at one point of the day, after the market opened, right, the price at one point went all the way up to this high point here and went all the way down to this low point here. But when the market closed, it closed here, all right? That's what the wicks represent, okay? Same thing for the bullish candle. When the market first opened, the price opened here. At one point during the day, it dropped all the way down here, the price. And at one point during the day, it went all the way up to this high point here. But when the market was done and it closed at 4 p.m. Eastern time, the price closed here. And that right there is the body. Everything outside of the body will be considered a shadow or a wick, okay? So we're going to do a few basic candlestick patterns, all right, just so we can break down a few things and just give you a couple ways to gauge what you're looking at on the chart and how to use that information to get profits when you're trading. If you want to get a deeper demonstration, you can go and purchase the course, a candlestick cheat sheet course. I actually have a cheat sheet that has the most recognizable chart patterns or candlestick patterns, so you can see them and they tell you what exactly these patterns mean, and then you can apply them to your trading strategy and become more profitable. I break down each and every one of those candlestick patterns, and you can always use that as a reference or something that can help you add towards your trading tactics or your trading techniques, and it will help you minimize your risk, maximize your reward. That's all we're about. So we're going to go through a few basic ones now, but if you want a deeper demonstration with more to choose from as far as the patterns are concerned, definitely tap into the candlestick cheat sheet course. All right. So basic candlestick patterns. Candlesticks are created by up and down movements in the price. While these price movements sometimes appear at random, at other times they form patterns that traders use for analysis and trading purposes. There are many candlestick patterns. Here's a sampling to get you started. Patterns are separated into bullish and bearish. Bullish patterns indicate the price is likely to rise, while bearish patterns indicate the price is likely to fall. No pattern works all the time, as candlestick patterns represent tendencies in price movement, not guarantees. All right, so let's get into a few candlestick patterns. The first one we're going to talk about is a bearish engulfing pattern. A bearish engulfing pattern develops an uptrend when the sellers outnumber the buyers. This action is reflected by a long red real body engulfing a small green real body. The patterns indicate that sellers are back in control and that the price could continue to decline. So let's look at it as an example. Right now, we're looking at Facebook. So we got introduced to Facebook in the last class so we can see what's going on with Facebook and if we can find any of these patterns in here to show you what might have happened if you was able to respond to them at the right time. All right. So if we go back, we can go and see, this is the first one that I spotted. All right. So here from January 22nd to January 27th, you have a price sequence right here, right? This would be considered a topping pattern because it's at the top of price movement. All right. Now, if we go back, and this is why I like TradingView. So if any of you guys want to really get deep into technical analysis and start practicing and back testing meaning going back in time and testing your strategy over and over again and seeing how often you win or often you lose with that particular strategy, definitely tap into TradingView.com. There's a free version available. There's a professional version available for you to pay monthly or yearly, however you decide to do it. I have the maximum amount of ability on my particular plan to gives me all the indicators, gives me all the functionality, and it helps me in my trading journey, and it actually pays for itself. So definitely tap into TradingView.com. You can go back in time, you can add your indicators, you can do your measurements. All the technical analysis you need can be done from TradingView.com. It's not a software that you need to download or any of that. It's just a website. You can also go to bstworldnews.com. On the homepage, you can scroll down and you'll see a chart right there for you to start practicing on without having any memberships or anything like that. You can use BST World News to help you get started with TradingView. All right, so this right here is a bullish candle from January 26th, right? Not really telling us much except the fact that there's a shadow or a wick at the top and not as much at the bottom. So just from looking at that right there, using our description from what we just did in the presentation, this right here is telling you that sellers are pushing the price down, because at one point during the day, the price actually went all the way up to here, $285.32. But then it closed all the way down here at $282.05. So at one point it went up, and then people started selling the stock, which forced the price to go down, and it ended up closing here. So that is enough information for you to see what might happen the next day. And if the next day we end up being bearish, now you know that it's a potential trend reversal. And then we start getting into candlestick patterns to see how we're going to respond to it. All right. So boom. Now, the next day, we got a bearish candle. The bearish candle opened up here above where it closed at the previous day, but the body actually engulfed the previous day's candle. So this bearish candle right here engulfed the previous day's bullish candle, right? This is a bearish engulfing candle. Now, if we look at the description or the explanation of what a bearish engulfing candle is, this is a pattern that if you can spot at the right time, will give you a gauge on where the direction of the stock might actually be going in the future. Now, huge bearish engulfing candle. This body is way bigger than the previous day's body. What that's telling you is, if you were looking at taking a short position on Facebook during this time frame, now would be the time for you to do it, because the bearish engulfing candle just showed you that the momentum for sellers is way stronger than the momentum for buyers moving forward. Now, it's not going to tell you how long this bearish momentum is going to last, and it's also not going to tell you at what price point is going to stop selling off at. But all you can do is go ahead and use your risk management, which we'll get into a little bit later, to gauge where you want to get into, how much money you want to invest, and at what point you want to get out, at what point you want to get in. So if we move forward and look at what might happen after, you see the next day, you got another bearish candle, right? Even though you had a wick, a huge wick here, you still ended up closing way below where you closed at the previous day. So you see this big wick, understand that at one point in the day, the price actually went all the way up higher than where it did back here when we first got our signals, right? And this is why trading psychology is very important. We'll get into that later. Trading psychology is very important because you need to make your mind up and know which direction you want the stock to go. You need to name your target before you get into your position. If you name your target, You need to leave all of the guesswork out of the equation and just let the stock go where you think it's going to go. All right. Now, this position only would have hurt you if your stop loss was about here. And if you don't understand what stop loss is, we'll get into that later when we talk about risk management. But if you had your stop loss here right at this wick, then you would have got stopped out and you would have lost money in this case, because the wick actually came above your stop loss. In that case, you would have ended up losing. But anything outside of that, if you were bearish on this stock, solely based off of the candlestick pattern that we see here, bearish engulfing, you would end up being in profit at the end of the day, right? Now you got another day of profit here. And then if you keep going forward, the next day, you got another day of bearish movement, right? And then you got one day where we start going a little sideways. So if you would have jumped into this particular trade based off of the bullish engulfing pattern that you saw on the 27th, let's just say, for instance, you got in right around here on the 28th and traded it down, you would have put yourself in position to get, well, the price declined 6.39%. And if you shorted it, you would be in profit over 6%, going in the opposite direction. All right. So that would be a bearish engulfing candle, and how you will respond to it by going short on a stock like Facebook. Judging off of these candlesticks, you would have ended up being very profitable using that strategy. All right. Now, let's move on to the next one. So the next one we're looking at is bullish engulfing patterns. All right. So an engulfing pattern on the bullish side of the market takes place when buyers outpace sellers. This is reflected in the chart by a long green real body engulfing a small red real body, with bulls having established some control. The price could head higher. All right. So in this example, let's see if we can find a bullish engulfing pattern here on Facebook. All right. Let's see. All right. So I have one here. All right. So I got one here on March 25th. On March 25th, you got, and let's replay this and cut this back so we can see in real time. March 25th, you got bearish movement. Not only do you have bearish movement, but you also have a huge wick letting you know that the sellers are here and they're pushing the price down. But you also have a small wick on the bottom letting you know that there are some buyers here. We just don't know how strong these buyers are, right? That's all the information that we can take from this situation right here. The next day will be determined, or the next day will determine what direction the stock is going to go. If we open up bearish, when we close bearish, then that's letting you know that the momentum is going to continue to drop. Stock price is going to continue to drop. It's going to continue to go on sale. And we're going to have to see what strategy we're going to use moving forward. If we want to jump in for a short position or not, we'll just have to see. All right, so we open it up for the next day. The next day opened up below the price. So if you were quick to jump into the stock and get in a short position based on the information that you saw here, you would have got a short position here, right? And in hopes that the stock price went down. This is very important because a lot of people make the mistake of jumping in and out of the market within the first 10 minutes of the market open. That can be very risky, because when you gain some experience, you'll see and you'll understand that when the market first opens at 9:30 a.m. Eastern time, it's very, very volatile. Stocks are going up, they're going down, they're moving. It's a lot of movement the first few minutes of the market open. If you're going to get into a position, especially a long-term position or a swing position, I would suggest for you to stay calm, probably for the first 30 minutes of the market open, just so things kind of calm down a little bit before you decide to take a big position into a stock, hoping that it goes in one direction or the other. That's my suggestion, especially for beginners who are new. I suggest you take the first 30 minutes at least when the market opens to just sit back and watch to see what's going on. And then from there, moving forward, you'll see the volume start to steady out a little bit. And then you'll have a little bit more confidence to see which direction the stock is going to go. That's not to say that the first 4 hours of the day, the stock could move one direction, and then the other 4 hours of the day, it goes in the total opposite direction. That can happen as well, right? But just to be on the safe side, you want to kind of see if jumping into a stock as soon as the market opens is the best strategy for you or not. I think as a beginner, you probably should wait until things kind of calm down first before you jump in or exit. All right, if you're in profit by a large amount when the market first opened, maybe that'll be a good time for you to exit. But that's the reason why things are so volatile, because you won't be the only person thinking that. It'll be hundreds and hundreds of thousands of other people thinking the same thing. And that's the reason why there's so much movement, because people are exiting positions, entering positions, jumping in, jumping out of the market. And until things settle out, you'll start to see, a little bit of trickery when it comes to price and the direction that the stock might actually be going for the rest of the day. So as you can see here on Facebook, it opened up down here and it actually went all the way down here. You can see by that wick, the wick brought the price all the way down here. So at one point it was completely red, right? And then it turned around and went all the way up to here, about 280, what is that? About 280, 284.68. Then it actually closed here at 283.02, right? This right here is a bullish engulfing candle because the body of this candle engulfed the previous day's body, right, by a pretty good amount. That right there is a signal for you to look at getting a long position on Facebook with this chart, this candlestick pattern right here. It's letting you know that a trend reversal might be taking place. All right. So if we move forward, you can see that the next day, price actually gapped up, right? So the gap between where it closed at and opened at right here went from 282.99 all the way to 285.71. That gap in price right there is a huge jump, right? So if you saw that there was a bullish engulfing candle and it closed this day, and you were quick enough to get into the trade right before the market closed, the next day you would have made an extreme amount of profit, because not only did the stock price go up, but it jumped up and skipped over about, what is that? 1% of price got skipped over through pre-market trading and put you in profit immediately. And then you worked your way all the way up to close at 290.82. And if we continue on for the next day, you can see what happened a few days after that. You got another gap up in price, and then you got a real uptrend. So that was a real trend reversal that you might have caught by looking at the bullish engulfing candle on Facebook back in March 26th. And let's just say, for instance, you ended up getting into this right at the market close and you traded all the way up to the highest point. You would have been able to take home 11.75% profit just off of a simple swing trade. And that right there is what we look for as swing traders. So over a 10-day period, a little bit over a week, you would have been able to make 11.75% return on Facebook just by using the candlestick reversal pattern of a bullish engulfing. All right. If you want to get deeper into the candlestick chart patterns, definitely go and get the chart pattern, candlestick chart pattern cheat sheet course, which is available at bstuniversity.com. Definitely check that out. We get very, very deep into all of the chart patterns on the cheat sheet. And if you memorize them and recognize them, you'll definitely become a more profitable trader, and it'll make your job a lot easier and it'll make your money a lot faster. All right. Thank you guys for that. Let's go ahead and keep it moving. All right. So the next thing we want to talk about is chart timeframes. All right. Very important that you understand chart timeframes. The reason why is because depending on what kind of trader you are, the chart timeframes will help you tremendously. So in this case, we're swing trading. We understand that we're going to hold these positions for days, sometimes weeks, sometimes months, but for the most part, days, right? So the example I just gave you, over a 10-day period, you made over 11% on a Facebook trade. That's a great swing trade, right? But on a daily chart, that's what keeps your sanity as a swing trader, because now you don't have to just stare at the chart all day like a day trader would, right? You're just looking at the daily movement. So you might glance at the chart from time to time throughout the day, but overall, you're looking at day 1, day 2, day 3, day 4, day 5. Looking at the candlestick for each day will help you keep your mind at ease and know that I'm not really making any movements or judgments until I see this candle close. And then the next day I'll make my decision on whether I want to exit or enter a trade. And that will help you. Now, let's say, for instance, we're looking at a higher time frame, like a weekly chart. If we look at a weekly chart, each candle on this chart represents 1 week, right? So today is Tuesday, all right? So Monday, this candle opened here, all right? Now we're Tuesday, and the body of the candle has already gone above and beyond the candle from the previous week. We're clearly in a bullish trend. So you can do a simple trick, right? For a lot of people in my VIP membership, they understand this, right? When it comes to like the middle of the week, like a Wednesday, you can pull up the weekly chart and see the direction that the stock is going. If by Wednesday, you got a nice body on the candle, it's predetermined on what direction the stock is going. We're already in a trend, right? We're already bullish. Now we're just trying to see if I should jump into the trade this week or next week, right? If I look at the weekly candle and it's telling me that it's a bullish week, then I can go down and scale down to a smaller time frame and look at what day do I want to jump into this particular stock. So today is Tuesday. Yesterday was Monday. So this huge candle right here is, giving us an understanding of why you got this such a big body so early in the week, right? And then the wick on the weekly candle right here is representative of today, where you have a big wick on the day, and then the body starting to establish itself down here, not really knowing what direction it wants to go. Right now, it's simply a doji, which is a candlestick term, a doji, right? Not really knowing which direction it wants to go. And we need to be patient in this case. Right now, it's 3:41 p.m. Eastern time. We got about 18 minutes left until the market closes. Doesn't really look promising for today as far as the direction and a continuation of bullish movement. Let's see what happens tomorrow with the direction on Facebook, right? So that's how you go back and forth between the weekly and the daily. Let's look at the monthly. If we look at the monthly, every candle on here is representative of 1 month. Same situation. Today is the 31st of August, right? So obviously tomorrow we're going to have September 1st. A new candle is going to open up on the monthly chart. Now we have to see which direction we think the stock is going to go by determining what type of body or what type of wicks we have on the monthly chart. And that won't be just basically, that won't be settled until probably halfway through the month. We could kind of see what's going on with that particular stock, right? So let's see if we go down to the 4-hour chart. If we go down to the 4-hour chart, you see the market opens up at 9:30 a.m. Eastern time, closes at 4 p.m. Eastern time. That's basically an 8-hour day. So if we go down to a 4-hour chart, 2 candles on this chart represents 1 day, right? So if you wanted to get a better breakdown on what you see on the daily chart, you could scroll down to the 4-hour chart and get a little bit more of a definition of what that actual daily candle is on the inside, all right? If we go down to the 2-hour chart, now you understand that 4 candles on the 2-hour chart represents 1 day on the daily chart. So if you're looking at a daily candle and you go down to the 2-hour chart, you can see what's been going on in between each 2-hour period of the day. And the candles on this chart will represent what's actually happening. As you can see, Facebook has been moving sideways the whole day. And that would basically explain why you have this doji here on the daily chart, right? So if you see the doji on the daily chart and you go down to the 2-hour chart, you go down to the 2-hour chart, you can see that you got 4 candles right here for the day. And each one of these candles is pretty much in the same price range. And that's why you have a doji on the daily chart. You go down to the 1-hour chart, you can see that you got pretty much 8 candles for the day. And now that you can see what the last hour of the day is doing, you can see that the last hour of the day sell off for the day, and we're probably going to end up closing in the negative for the day as far as Facebook is concerned, right? So for day traders like to operate on a smaller time frame. You know, a 1-hour time frame maybe is probably the most comfortable place for a day trader to be. And then anything less than that gets a little hectic because the price movement can be very, very violent throughout the day. But as far as a swing trader, a comfortable chart for you to sit on, daily chart. Daily chart is probably the most comfortable place for you to be as a swing trader, because you don't have to worry about looking too much at the chart. You can just glance at it from hour to hour a day, or, you know, on your lunch break or whatever the case may be. This is suitable for someone who has other things to do throughout the day and can't dedicate their time and vision and focus to the chart all day. Because if you just sit here and stare at the daily chart, you're not really going to see much going on. There's not going to be much action. It's just one candle that you're watching, and that can get pretty boring. But if you go down to the 1-hour chart, every single hour you got a new candle establishing itself, and you standing here staring at that, it can get kind of nerve-wracking, right? But either way, you're not going anywhere for the day. The day's candle is here for you to gauge what's going on, and I think that that's probably the best place for you to stay as far as monitoring your positions. All right. So the next thing we talk about is getting a little bit deeper into technical analysis. Now we're talking about moving averages. All right. So we talk about the moving averages, and I introduced those to you in the first class. Now we're going to get into a description of what exactly these moving averages are. All right. Oh, okay. All right. So moving averages. What is a moving average? In statistics, a moving average is a calculation used to analyze data points by creating a series of averages of different subsets of the full data set. In finance, a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. By calculating the moving average, the impacts of random short-term fluctuations of the price of a stock over a specified time frame are mitigated. All right, so basically we're using the moving averages to help us stay calm and let us understand exactly what direction the stock price might be going by using previous price history, and we're using that previous price history to determine where we think the price is going to be going in the future. All right, so key takeaways: a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified period of time by creating a constantly updated average price. A simple moving average is a calculation that takes the arithmetic mean of a given set of prices over the specific number of days in the past. For example, over the previous 15, 30, 100, or 200 days. Exponential moving averages is a weighted average that gives greater importance to the price of a stock on more recent days, making it an indicator that is more responsive to new information. All right, so there's a difference between a simple moving average and the EMA, exponential moving average. Basically, the EMA gives you a better representation of current price movement, more recent price movement, and a regular moving average or a simple moving average is a little bit more lagging than exponential moving average. And I'm going to show you how to use both, basically. So understanding moving averages. Moving average is a simple technical analysis tool. Moving averages are usually calculated by identifying trend direction of a stock to determine support and resistance levels. It is a trend following or lagging indicator because it is based on past prices. I told you in the first class, these are lagging indicators. So again, there's going to be plenty of people out there that's telling you how to use different strategies on entering and exiting stocks based on the moving averages crossing, based on price crossing moving averages and all that. And we'll get into those as well. But I need you to understand that these moving averages and most of these technical indicators are lagging. They're calculating previous price movement to determine what the price might be doing in the future. All right. So you cannot base your sole trading strategy on a lagging indicator because you're always going to be late if that's how you operate. All right. It's just is what it is. So the longer the time period for moving averages, the greater the lag. So a 200-day moving average will have a much greater degree of a lag than a 20-day moving average because it contains prices for the past 200 days. The 50-day and the 200-day moving average figures for stocks are widely followed by investors and traders and are considered to be the most important trading signals. And we're going to get into a very easy strategy to determine what side of the market we're on by using the 50 and the 200-day moving average. We'll do that in a second. Moving averages are a totally customizable indicator, which means that an investor can freely choose whatever time frame they want when calculating an average. The most common time periods used in moving averages are 15, 20, 30, 50, 100, and 200 days. The shorter the time span used to create the average, the more sensitive it will be to price changes. The longer the time span, the less sensitive the averages will be. Investors may choose different time periods of varying lengths to calculate moving averages based on their trading objectives. Shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors. All right. A rising moving average indicates that the security is in an uptrend, while a declining moving average indicates that it is in a downtrend. Similarly, upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Conversely, downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average. While calculating moving averages are useful in their own right, the calculation can also form the basis for other technical analysis indicators, such as the moving average convergence divergence, the MACD. All right, so we're going to talk a little bit about the MACD in the future, but as of right now, we're just going to give you a brief description of what it actually is, just so you understand. The moving average convergence divergence is used by traders to monitor the relationship between two moving averages. It is generally calculated by subtracting a 26-day exponential moving average from a 12-day exponential moving average. When the MACD is positive, the short-term average is located above the long-term average. This is an indication of upward momentum. When the short-term average is below this long-term average, this is a sign that the momentum is downward. Many traders will also watch for a move above the below zero line. A move above the zero is a signal to buy, while a cross below the zero is a signal to sell. All right, so that's just a brief description of what a MACD is. And we'll show you what that looks like on this chart here in a minute. Types of moving averages. So simple moving average is the simplest form of a moving average known as a simple moving average. It's calculated by taking the arithmetic mean of a given set of values. In other words, a set of numbers or prices in the case of financial instruments are added together and then divided by a number of prices in the set. The formula for calculating the simple moving average of security is here. Not very important for you to memorize or understand or even use this. Technical analysis, most of the charts that you see people working with, the ones that I suggest, tradingview.com, you're going to see the moving averages are already going to have the calculations in them You don't have to do it. It's done for you automatically. All right. So there's no need for you to memorize the calculation unless you just like math that much. The exponential moving average is a type of moving average that gives more weight to the recent prices in an attempt to make it more responsive to new information. To calculate an EMA, you must first compute the simple moving average over a particular time period. Next, you must calculate the multiplier for weighting the EMA, which typically follows the formula listed here. So for a 20-day moving average, the multiplier will be, two over 20 plus 1. Then you would use a smoothing factor combined with the previous EMA to arrive at the current value. The EMA thus gives a higher weighting to recent prices, while the SMA assigns equal rating to all values. So here is the formula for the EMA, which you see is a little bit more deeper and complex than the regular SMA for obvious reasons. We want to calculate the most recent price movement. You're going to have a deeper calculation to deal with. But again, you don't need to memorize these calculations or these formulas. It's already done for you with the indicator that we upload onto your chart, especially if you're using tradingview.com. All right. So the simple moving average versus the exponential moving average. The calculation for the EMA puts more emphasis on the recent data points. Because of this, EMA is considered a weighted average calculation. In the figure below, the number of time periods used in each average is identical to 15. EMA responds more quickly to the change in prices than the SMA. You can also observe the figure in that EMA has a higher value when the price is rising than the SMA, and it falls faster than the SMA when the price is declining. This is responsiveness to price changes is the main reason why some traders prefer to use the EMA over the SMA. We're going to use both. So I'm going to show you how to use both, and we're going to get into that moving forward. And that's pretty much wrapping up everything we need to understand about the moving averages. So let's look at some real examples. All right. So we're still checking out Facebook. For those of y'all who are wondering what that bell sound was in the background, that was my alert for another stock that I'm looking to get into. So with TradingView, what you can do is you could actually set price alerts on indicators and on the chart itself to let you know what's happening with the particular stock that you're looking at. That way you don't have to stare at the chart all day. You can actually just set your alerts and let it go. And then if the alert goes off in the future, now you can pull up your chart and see exactly what's going on with that particular stock. So if you're wondering what exactly was going on while I was talking and that alert went off, let's go ahead and look at my alerts and see what happened. All right. So here, right now I'm in Walgreens Boots Alliance. This is a very, very good stock to trade. It's also a very good stock to invest in long term. Why? Because they actually pay dividends. And we'll get into that in another course. We'll have a dividend trading course for those of y'all who want to get into dividends, free passive income that these companies pay investors for investing and buying shares in their company. Most of these companies pay quarterly. So every 3 months, you get a new payment. 4 payments throughout the year. A lot of these companies pay a relatively good price or yield for the investors that invest in this company. Walgreens Boots Alliance is one of the companies that actually gives you about a 3.94% yield, which means that for every dollar that you put into this particular company, you're going to get 3.94% back in cash flow every single time, every single year that you invest or hold your position in this particular company. So the alert that I got was an alert that I set on the 4-hour time frame. I set an alert on the 4-hour time frame when the price crossed over the 200 moving average. So as you can see, the 200 moving average on the 4-hour chart, the price has been crossed. All right. And I got an alert as soon as that happened. Why did I set an alert at the 200 moving average cross? Because that's letting me know that the price is moving in the direction that I thought it was going to go, or that I think is going to go, or that I anticipated for it to go. Right. And I have multiple price targets for this particular stock, but I plan to hold this for a while. So on the daily chart, you see that the price already crossed the 200 moving average on the daily chart. Now, why is the moving average down here on the daily chart, but on the 4-hour, it's up here, right? That can be kind of confusing. Remember, the daily chart is representative of the candles on here are 1 day. If you go down to the 4-hour chart, the candles are 2 days. Remember, these are lagging indicators. So if you're using the indicators, especially the moving averages, you have to understand that the moving averages are going to be on a different space on the chart for each time frame you're looking at, right? So it might look like this on the daily chart, but if you go down to the 4-hour chart or the 2-hour or 1 hour, they're going to be in totally different positions. So you have the ability to gauge how you want to respond pertaining to what chart, what time frame you're looking at on the chart. So that's why I said the daily chart is probably the best place for you to stay. But if you decide to go down to a smaller time frame, just keep in mind that these moving averages are not going to be in the same space as they were on the higher time frame, and they're going to be a little bit more. It's going to be a little bit more movement with these moving averages on the smaller time frame as well. All right, so let's just stay here for a minute. All right, now a lot of you guys are going to ask me, what is this blue and red box thing that we're looking at? This is a position tool. All right, this is one of the tools that TradingView allows you to get. All right, so just a brief understanding of this right now, so we know, what it is and not to confuse anybody. The red part of this is where the price, if the price goes down in this area, I'd be in the negative. All right, this line, this gray line, the separation between the blue and the red, that is my entry. All right, so I purchased Walgreens Boots and Lions stock at $49.04. All right, if the stock turns around and goes down into this area, I'm going to be in the negative. The bottom part of this red position tool is my stop loss. So if the price comes all the way down to here and below, I'm automatically stopped out and I'm exited the trade completely. All right. The top part of this is my target price, right? So as you can see, the target is all the way up here. If the price gets all the way up to my target, I would have then made 13.81% return on my position. And at that point, I would look to close my position or maybe even trim my position and take some of my profits off the table. I have the option to do that. And then along the way, I'll have multiple price targets. I have multiple price targets set determined by, other technical analysis of strategies and different things that I'm looking at. And we'll get into those in the future. But that's just a brief description of what this box is in case anybody is wondering. All right. So now let's just use this as an example since we're here. So now we have the 200 moving average here, right? This is very, very, very important for you guys to understand. Now you have the 200 moving average and you have the 50 moving average. All right. The 50 moving average is in purple. First, before we get into anything, if you are on TradingView and you want to know how to put these indicators on your chart, simply go to the top and you see this indicators and strategies. You click this, right? And then the menu will open up. If you want to put the moving averages on your chart, all you have to do is type in moving average. All right. You type in moving average and you see it here. All right. This is the moving average that's already built into the TradingView platform. If you want to keep it as a favorite, you just click this star here. So that way you won't have to keep typing it in when you want to add more of them on. But for each moving average that you put onto your chart, you need to add a new indicator for it. So for me, I have probably 1, 2, 3, 4, 5, about 5 moving averages on my chart. And I don't use them all at the same time, but I have them available. So if that's what you want to do, you would have to click moving average 5 times. If you just want it one time, you just click it one time. All right. In this example, we're using 2. So you would click it twice. If you click it twice, you click it one time, it'll pop up. You click it the second time, it'll pop up. Now, when they both pop up, you have to edit them. Normally, when they come onto your chart, they start you out with probably like a 9-day moving average. You have to edit that. In order to edit that, you want to go to the side and you see this drop down arrow right here where this 9 is at. You click that and it'll drop down all the indicators that you already have on your chart if you haven't, right? So if you just click moving average twice, you'll have 2 moving averages on here. The first one, all you have to do is go to the eye symbol to make sure it's visible. All right, and then you have a gear symbol here. You click the gear symbol and it'll open up the settings. You open up the settings, you can change the colors if you like. You can make the lines thicker, however you want to do it. All right, and then you have inputs. The inputs is where you adjust the length or the days of the moving average. For this one, I have 50. So that's the 50-day moving average. That's 50 days of previous price movement calculated into this line, and that's the length. All right, I don't mess with anything else. Don't mess with close, don't mess with offset, don't mess with visibility. Everything else stays the same, okay? All right, okay, boom. Now, same thing for the 200-day. This will probably start you out as a 9. You open up the gear symbol and you change that 9 to a 200. Then you also change the color and the line if you want it thicker or slimmer, however you want to do it. Save that, boom, you're done. That's all you have to do. Save the chart. So you don't have to keep doing this every time you open up TradingView. You can save the chart. Go to the right side here. Mine is saved as swing. This is my setting for my swing trades. If you want to save this, you click this cloud, right? And then you drop down and you can, boom, save as, rename, make a copy, upload a new chart, however you want to do it. I have it automatically saving every 10 minutes just in case I forget. But now it's here. I don't have to worry about it. When I want to upload something, it's already there. All my settings are here. I don't have to make any adjustments unless I want to. All right. If you want to adjust the settings on your chart, you can also go hit to the chart settings, change the background colors, change the chart candlestick colors, the wicks, the shadows. All that stuff can be adjusted. Free range to make your chart look however you want it to look. All right. So now 50-day moving average, 200-day moving average, right? Very, very important for you to understand how we use these two, okay? Now, this is to keep everything simple so you guys are always on the right side of the market, okay? If the 50-day moving average is above the 200-day moving average, that will be representative of a bullish market. If the 50-day moving average is below the 200-day moving average, that would let you know that you are in a bearish market. Sometimes the moving averages will be very close to each other and they'll intertwine and go up and down. When they separate is when you are able to make that true distinction of whether you're in a seller's market or a bullish market. So if we look at Walgreens Boots Alliance back here, back in January, beginning of the year, you'll see that the 50 moving average crossed over. Now, when we first introduced the moving averages, there's a few things in the presentation that said that you can use the moving average crosses as an entry to help you get into the trade. Now I'm going to show you why it's important for you to understand that these moving averages are lagging indicators. And if you're using them to help you get in and out, it might hurt you in the long run because you're missing price movement because price moves faster than the moving averages do. All right. So let's just play this back and see what actually happened. So price already crossed over the 200 and the 50. The 50 hasn't crossed over the 200 yet, right? Now, the 50 finally crossed the 200 moving average. Let's say you were one of the individuals who are waiting for the 50 to cross the 200 before you got into a long position. You just missed 20.18% of price gain by waiting for the 50-20 cross, 5200 cross. All right. Understanding that the more time you have on the moving average, the slower it's going to move. So 50 days is very slow. 200 days is very, very slow. Now, maybe if you had a shorter time frame moving average, you might have been able to get a good amount of gain and get in at a quicker time. But either way, price is king. Price is always going to be king over all of these indicators that we're going to introduce you to. You have to go off of price first and then use the moving averages and the other indicators as confirmations to help you stay calm and understand exactly what's going on as far as the price movement, trends, resistance, support, and all those other things. All right. So here's another example of resistance and support. Here you can see that the moving average, the 50 moving average, is acting as support to price. Why is it support? Because the price came all the way down and tested the 50 moving average and bounced off of it, right? Then it came all the way down and tested the 50 moving average and bounced off of it again. These two bounces off of the moving average let you know that the price doesn't want to go below the moving average. That will be considered support. So not only do these moving averages help you gauge what direction the stock is going or what kind of market we're in, but it also helps you find support and resistance at times when you can see that the price is actually responding to where the moving averages are situated on the chart. All right, so now we just broke down a few things real quick. Hopefully you guys understood everything I said, and if not, you can play this back over and over again until you get a good gauge of what I'm talking about. All right, so moving forward, now we understand where we're at. Now we're in a bullish market. All right. We were in a bearish market for a minute. All right. So Walgreens Boots Alliance, the 50 moving average was below the 200 moving average. Started back here in February 2020. So from February 2020 all the way up until January of 2021, you were in a bearish market, right? So if you're a long position swing trader, or someone who likes to only take long positions, someone who only wants to get into bullish stocks, which I would hope that a lot of you guys are, especially beginners, probably shouldn't be looking at short anything at this particular point. Probably should only be looking to get into long positions or bullish positions or bullish trends, because remember, the stock market is 70 to 80% bullish. So if you are bullish most of the time, then most of the time you're going to be right. So you want to make sure that you jump into stocks at the right time by making sure that they are actually in a bullish market and not a bearish market. 50 below the 200 moving average here. Last year, 2020, complete bearish market. No reason for us to look at getting in this particular stock until we start seeing that the stock price is moving in a direction to where it wants to get over the 200 moving average. All right. So now that the price has crossed over the 200 moving average and cleared it, now you got the 50 moving average getting pulled up. Now you got the 50 above the 200. What kind of market are we in at now? We're in a bullish market, right? So from here, from this point moving forward, we're looking for bullish entries. All right. In order for us to find bullish entries, we need to make sure that we get them at the right time and not buy in when the price is too high. We want to buy in at a point to where the price is low enough to where we still have some potential gain to get in the future. Okay. So now we got that under control. So just remember this. When the 50 moving average is above the 200 moving average on the daily chart, you're in a bullish market. When the 50 moving average is below the 200 moving average on the daily chart, you're in a bearish market. Okay. From there, you will be able to gauge what kind of position you want to be looking to jump into. If the 50 is over the 200 and we're in a bullish market, I'm looking for bullish entries. And I'm trying to find out at what point do I want to put my money at risk and buy into that particular stock to see if I can get some gain. All right. So let's go ahead and fast forward to now. All right. So now, if we look at what I was looking at and why I decided to jump into Walgreens, even though the 50 moving average is below the 200 at this particular time, you can see clearly that the price has a resistance level, right? So when we talk about support and resistance, what do we mean? We're talking about support, the price not wanting to go below a certain price range, right? And we kind of use that with trend lines. We can use that with moving averages. We can use that with different types of tools and stuff that we can put on our chart to gauge where the price is stopping at. The price is stopping here, all right? And you can see that this line is pointing up. So it's clearly an uptrend. If we go back in time, and this is the reason why technical analysis is so good, you can go back in time and see what happened last time when you got a trend moving up. So when you see an uptrend, how do you know when there's an uptrend? What is an uptrend and what does it mean? And how do I find an uptrend? When you're looking for an uptrend, you're looking for price movement. You're looking for low points and you're looking for high points. When you're in an uptrend, you have low points. So this would be considered a low point. All right. Let me make sure you guys can see that. All right. This would be considered a low point. This would be considered a low point. This would be considered a low point. All right. And we can put another one on here. This could be considered a low point. In each price sequence, the low points were higher than the previous low points. So we call that higher lows, right? So when you see a sequence of higher lows, that right there is telling you that it's a clear uptrend. All right. Now, everybody has their different theories on how many higher lows you need to see in order to really determine if there's a real uptrend. To me, you really only need to see 2 or 3. All right. So I saw 3, one here, and one here. On the third one, it crossed over the 200 moving average and went completely bullish. And then we got ourselves in a position to where we could make an extreme amount of money in a short period of time. right? That right there is what you're looking at to determine if you're in a bullish trend or not. Now, also, you can also find another form of determining factor to see whether you are in a bullish trend or not, looking at the high points, right? So we're going to put a green one on this one. So you got a high point here. You got a high point here. All right. You have a high point here. And you even got a high point here. All right. So all of these examples of high points were higher than the previous high points. So those will be considered higher highs. So now you have higher highs and higher lows. When you have a situation where you have constant sequences of the price giving you higher lows and higher highs, hands down, you're in an uptrend. You're in an uptrend, you're in a bullish trend. And when you're in a bullish trend, you want to see if you can get in and get out, get in and get out, or get in at the best price possible and hold it until the trend is completely done. And that's what we're trying to do as swing traders. Now, finding these high points and low points are very, very valuable. All right, you guys have to spend some time looking at these charts and playing around with this stuff to see if you can find them on your own. And you can always use this video as a reference, obviously. But this is what we're always looking for. We're looking for higher highs and higher lows. Now, fast forward to today, you can see we have a support level with the trend line. We have a resistance level with the moving average here, the 200. Price constantly trying to get above, constantly trying to get above, constantly trying to get above. Come down, hit a support level, boom, it busted above it. And then it even broke above the 50 moving average, but it didn't stay up there. It came right back down again. But when it fell, it stopped right here at the support level again. So now you got one here, one here, one here. These are all tests. All right, price keeps testing this move, this level. This trend line keeps getting tested over and over again. The more times your trend line gets tested, the more times your trend line gets tested, the more valuable and strong your support level is, right? So if you get your support level gets tested 1 time, 2 times, 3 times, 4 times, that lets you know that this support level is solid. Price does not want to go below this level, and I should probably start looking to get into a long position the next time it bounces off of this trend line. All right. And then the resistance level, same thing. Price constantly trying to break this level. Finally broke it, came back around, break this level, boom, when it finally broke it. You're just trying to figure out when you want to get in. So that's why you heard those alerts going off in the background, because those alerts let me know when these moving averages are getting breached. And when the moving average gets breached, depending on what my strategy is, that will give me a signal to jump in for a long position. All right. So in this particular case, I was waiting, obviously, for the price to cross over the 200 moving average for me to get into a long position. All right. Maybe I got in here. All right. My original position might have been here. All right. Because same rules apply. I got 2 tests here on the support level. I got moving averages acting as resistance. Price squeezed in between both of them. And then the price finally breached the 200 moving average. Maybe I got a long position right here. Maybe my target was up here. Maybe my stop loss was down here. Maybe the price came back down and I stopped out and I lost money. That's just one loss that I took as a trader. Part of the game. The beauty about trading is the game don't stop. So if you do take a loss like that, that was a strategic loss that you took using all of the technical analysis and strategies that you have available for you. You minimized your risk. Most people that you're dealing with are not going to take all of these different things into the equation before they jump into a stock. Most people, especially beginner traders or beginner investors, they're going to go off of their own logic, which normally is 100% wrong when you're talking about professional trading and professional investing. A lot of people say you should invest in the companies that you like, or you should invest in the companies and the brands that you use the most. Maybe that could be a good strategy to use, but at what point are you supposed to buy in? That's what we're learning here with the swing trading course. We're not only learning how to do it, but we're learning when is the right time for you to do it. When the right time for you to do it, all these different check marks have to be crossed, right? Moving averages have to add up. Support and resistance have to be spotted and marked on your chart. right? Risk and reward ratios. We'll get into that when we start talking about risk management. All that stuff has to be in the equation before you even jump into the stock. So now that I know my trigger to enter is when the price crosses over the 200 moving average. If the price crosses over the 200 moving average and comes back down 3 or 4 times, I might lose 3 or 4 times in a row and be okay with that because my support level is still strong, right? Then the one time when it actually does cross over and stay, I'm going to make all the money back that I just lost with those previous L's and move forward in a profitable and positive direction. That's the risk and reward that we deal with when we're trading. And this is the reason why you have to figure out how to stay in the game by not putting too much of your account into each individual position and balancing your portfolio the right way. And we'll get into that in the future. All right, so this is exactly what we're looking at here with these moving averages. Now, also, another moving average that we want to look at would be the 20 moving average, 20-day moving average, right? And we'll start talking a little bit more in detail about that when we start talking about the cycles of the market. But the 200 moving averages or 20 moving average is very significant as well, because for a lot of us, the 20-day moving average is the first or the second trigger that we use to just jump into the stock if everything else is adding up. So if I was using the 20-day moving average in this scenario, I would have been in Walgreens Boots Alliance way back here. And maybe my stop loss would have been down here. So if that was the case, I would have been in profit already. And even though the price went up and came back down here, I probably still would have been in profit because the price didn't stop. The price stopped back here and continued to go up. And my initial entry was probably somewhere here when the 20 moving average got crossed, right? So there's different ways for you to use these moving averages, but for the most part, the 3 ones that we want to focus on the most would be the 20, the 50, and the 200. Remember, the 50 and the relationship between the 50-day and the 200-day on the daily chart. That relationship is very important for you to determine what side of the market you're in, bullish or bearish, right? The 20-day moving average will be helpful for you to find good entries if everything else is adding up correctly. So if the price crosses over the 20-day moving average, that could be used as the first signal for us to start looking to establish a long position when we think that the price is going to be bullish and we're starting a new bullish trend, all right? So the next thing that we want to look at is another indicator called the RSI, all right? This down here, this line down here on the bottom of my chart, that right there is the RSI. Let's get into it. All right, so relative strength index. So the RSI is the relative strength index, okay? What is the relative strength index? The relative strength index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. The RSI is displayed as an oscillator, a line graph that moves between 2 extremes and can have a reading from 0 to 100. The indicator was originally developed by J. Wells Wilder Jr. and introduced in his seminal 1978 book, New Concepts in Technical Trading Systems. Traditional interpretation and usage of the RSI are that values of 70 or above indicate that a security is becoming overbought or overvalued and may be primed for a trend reversal or corrective pullback in price. An RSI reading of 30 or below indicates oversold or undervalued condition. That right there is pretty much all you need to know about the RSI. I can continue to go on and get into greater detail about the RSI and the formulas that are inside the RSI and how they're used and what all that stuff means. To me, to be honest with you, none of that stuff is really important. We're only using this indicator to gauge whether we're overbought or oversold. So just to give you an example, and we can clear this up real quick. Just to give you an example, we understand what the RSI, we understand what the moving averages mean. Now we're talking about RSI. RSI down here All right, so we have the RSI right here. This blue line is what we're looking at. These bands on the end of on the top and bottom. And let me just make these a little bit more clear for you to see. All right. First, before we get into that, let's just make sure that you put it on your chart. So remember, go into the indicators up at the top, click on that, type in RSI. Very simple. Relative Strength Index. Put a star by it, click it. All right. This is the one that comes with the platform. You click that one time, it's going to show up on your chart down here. Click the gear symbol. Hit the gear symbol. Now you can go into style, change the color of the RSI, the upper band, lower band. Both of these one of these should be 70, one of these should be 30. The lower band should be 30, the upper band should be 70, middle band should be at 50. You can put that on there if you want. Very important for you to have that as well. The length has to be 14 days. Usually it'll already come there. You don't need to change it. Everything's set, you're good to go. Now, the upper band and lower band are the most important part of this whole thing. The lower band should be at 30, top band should be at 70. Now, when you see this line go below this band, that means that it's oversold. What does it mean when the stock price is oversold? That means that for this particular company, for this particular stock, the momentum has gone too far low, and it's probably about time for it to start turning around and go up. Now, just using that information alone is not going to make you a successful trader. A lot of people out here try to use that as a trigger for them to jump into stocks. People who like to buy the dip, right? So if you're using this and you say, I'm gonna just wait until the RSI goes below 30 and then I'm gonna just start buying up everything. You can do that, but just understand that just because the RSI goes below 30 doesn't mean that the stock price won't keep going down. The RSI can actually stay below 30 for a very long time. I could pull up a couple examples of stocks that have been below 30 for a month. I don't think you want to be in that situation. So don't use the RSI alone as a gauge for you to just jump into a stock or buy the dip. That's just an indicator to let you know where the momentum is at. It would be very beneficial for you to look at maybe jumping into a position when the RSI gets out of the 30, when it crosses back over the band. Now you can use that as a gauge to see if you want to start looking for an entry, not jump into an entry, because the band could get crossed and then it could get crossed again in the opposite direction. You don't want that either, right? Same thing in the other way, right? So when you see the RSI get all the way up to 70, and we can go back to see an example of that, price all the way up above 70, you see what happens, right? Price is up here, RSI is up here, it's overbought. So at some point, the price is going to end up dropping. Now, this is an indicator that has been invented, way back, right? People use this, right? I want you guys to understand this about indicators specifically. Indicators only work because everybody uses them. Strategies in trading and investing work because everybody uses them, right? Somebody just typed, "This is rigged." Yes, the game is rigged. The stock market is rigged, guys. You have to understand that. It's rigged in your favor if you understand what everybody is using. If everybody out there is using the same technical indicators and they're all using them the same way, then it's going to help you increase your win rate if you stay on the right side of those strategies. So if everybody out there is saying to themselves, Walgreens Boots Alliance is actually overbought, it's time for me to exit my position. If everybody says that, then guess what? Walgreens Boots Alliance is going to start dropping in price, and the stock price is going to go down. They're going to get out of overbought territory. And that's exactly what happens, right? Then it goes right back up into overbought territory again. Everybody's looking at the same thing. The RSI is overbought. It's time for me to get out of my position. Get out of your position. When you sell, the stock price drops. When he sells, stock price drops even more. When she sells, the stock price drops even more. The more people that sell, the lower the stock price is going to go, and then it brings everything down. All right, down, 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 down to the point to where it gets back to oversold territory. Now it reached oversold territory here. What if you was one of the individuals who said, I want to buy the dip? It's at 30% on the RSI, and the RSI is below. It's time for me to buy the dip. Maybe you bought the dip right here. Can you handle the price dropping all the way down? A lot of people can't deal with that. Most beginner traders and investors jump into situations like this because they're hearing people talking about buy the dip. They bought the dip, but then the dip kept dropping. And then they saw 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days in a row of bearish movement, and they done lost a good percentage of the money that they put in. Maybe they got in maybe they got in right around here. Let's see. Right when the RSI crossed over, and they got in right here, and it dropped all the way down here. Can you handle a 6.68% decrease in your money? Probably not. As a beginner, you're probably going to end up selling, and you're probably going to end up selling at the worst possible time down here, out of fear of it actually continuing to drop. When all actuality, all it was doing was getting ready to come back up. And then you look at the market and see, dang, it's all the way back to where I first bought it at, and it went beyond. What am I doing? You're dealing with the market with a lack of understanding and a lack of strategy and not knowing the whole big picture. That's why understanding technical analysis is the best thing that you could possibly jump into as a beginner trader, because now you can actually see these price movements, and putting these indicators together with all this stuff will help you get even sharper at this game. So see the RSI here showing you where we're at. Essentially what you want to get into is a position where you're not oversold, really, and you're not overbought. You never want to buy into a position when the RSI is in overbought territory. That's the worst time to buy. It might be a good time to sell, but not to buy. You don't want to buy when the stock price is at the peak of the market, or the peak of the sequence, or the peak of this particular time period. You don't want to do that. All right. That's not a good situation to be in. Even though stock prices could continue to go up and beyond where it's already at, once the RSI gets to 70, that happens. You still don't want to jump into a new position when it's already at 70 or higher. All right. I particularly don't like to jump into a position that's even at a 60 or higher, depending on what kind of stock it is. All right. In this scenario, I got in when the RSI was around 51.952. Right. So that is a good time to get in, around the 50% range. Pretty good time to get in. Now you're at a range to where it could go either way. And with all of the technicals adding up, the support, resistance, and all that stuff working in your favor, the moving averages crossing and all that, now you know that it's for sure going this way. You execute, you get into a long position, and boom, you're in profit. All right. So that's your RSI. All right. And that's pretty much it as far as we want to do. That's as far as we want to go with technical analysis as far as this beginner's blueprint swing trading class. If you want to get deeper into technical analysis, we have other courses for that. We have a candlestick cheat sheet. We have a chart pattern cheat sheet course. We have other courses that will give you deeper explanations into these moving averages and these technical indicators that we're using to become very profitable traders. If you're interested, go to bstuniversity.com and log in, and you can see those options available for you. But as of right now, technical analysis class is over. Thank you.